So these are the indicators, the 6 monthly indicators that the NBER, the National Bureau of Economic Research, uses to determine when the economy goes into recession, when the economy goes into a recovery. So when the NBER says or said the economy entered a recession in December of 2007, they're looking at these 6 indicators primarily to tell them the economy went into a recession in December of 2007. When they said that the economy entered a recovery in June of 2009, these are the six indicators that primarily told them that the economy was in recovery in mid 2009. Non-farm payroll employment, household survey employment, industrial production, real manufacturing and trade sales, real personal income, and then finally real personal consumption expenditures, real consumer spending. So we've abbreviated most of those here, but it's non-farm payroll job growth, household survey job growth, industrial production, real manufacturing and trade sales, that's wholesale trade and retail trade, real personal income, and then real consumer spending. And we're looking at the averages for 2025 versus the long-term average during economic expansions. And we're going back to 1970 here for these averages. The long-term averages during expansions, the long-term averages during recessions, and then the long-term averages in pre-recession periods. And these are the averages in the year prior to a recession. So for example, the average in 2007, or the average from the spring of 2000 to the spring of 2001, the final year of an expansion, the final year before the economy goes into a recession. That's that pre-recession column, the third column there. And so you can see here, 2025, again, we had non-farm payroll employment growth averaging 55,000 per month. That's well short of the typical gain in an expansion, 187,000 per month. Not nearly as bad, though, as we typically see in a recession, averaging minus 199,000 per month. But it's also much weaker than the typical trend in a pre-recession period, in the final year prior to a recession, 154,000. You can see in all of these cases, these indicators slow down prior to a recession. That slowdown, of course, has been much worse, as you can look at the final column here. That slowdown has been much worse in 2025 across these indicators, most of these indicators, than is typical in a pre-recession period. So you can see the next row, household survey employment. Again, not nearly as bad as a typical recession, but much weaker than typical pre-recession periods, much weaker than in the year prior to a recession. Industrial production averaged a gain in 2025 of 0.1%. That's weaker than the pre-recession period. Real manufacturing and trade sales actually a little bit better at 0.2% than typical pre-recession numbers. But personal income, and real personal spending, both softer this year than is typical, than we've seen on average in the year prior to recessions. So the upshot here is that the economy is much weaker than in a typical expansion. It's not nearly as weak as in a typical recession, but it's much softer than in a pre-recession period. So the risk is very much there, this risk of a slowdown heading into a potential economic downturn. Again, GDP pretty much in line with where it's been, and these last couple of quarters for real GDP have been very solid. But these monthly numbers have been fairly soft, and they continue to flash a warning sign that a recession is not yet, or a continued expansion is not a foregone conclusion.
To watch this month's complete analysis and receive daily updates directly to your inbox, become a member at cycleframework.com.